Alright, so I finally decided which investment strategy I'm going to pursue in 2019. So when I came out with this video back in January 17, I was still deciding between dividend investing, swing trading, or writing covered calls. So swing trading is basically what I've been doing for the past 3 or 4 years. And 2015, 2016, 2017 were good years, but obviously 2018 was pretty bad. Even if I don't take into consideration December, because December was the biggest reason why 2018 was bad. If I just take into consideration January to November, it was still sub 5% return per year. So I was looking for a strategy that works in any conditions. Dividend investing, of course, is the best strategy in terms of safety, passive aspect, long-term investment, value investing, because it allows me, of course, to just focus on quality stocks, not worry about the price, just buy it once, and if it drops again, if it continues to drop, then just buy some more, and then just let everything be. So definitely it is the one that requires the less time, the less effort. It is much less stressful, and over time, with compound interest or with the compounding effect, the dividends that you get every year are used to buy more shares that pay dividends, so you're slowly building up that machine that pays out dividends. So it's a great strategy, it's a great setup for retirement, but the only problem I have with it is the fact that it takes time. It requires time. It requires at least 25 years, in my opinion, if you'll be contributing to your investment account an average amount, let's say $1,000 or $2,000 a month. It's gonna take you at least 25 years before you can retire comfortably off the dividends alone. And another thing I don't like about dividend investing is that it could take you 15 years or 20 years to develop your portfolio or to grow your portfolio to reach a certain growth, and then in 1 year it can erase the past 15 years just like that. So basically that's that. So this buy and hold strategy kind of annoys me because of that. Although if you look at a longer period, even that 1 year that erased the past 15 years will get recovered in the next 2 or 3 years or 5 years. So if you look at a 25 or 35 year period, those crashes don't really affect it much. And what's great with dividend investing is that even when the market crashes, you're still getting those dividends. But what bothers me about it is the fact that it takes more time. And of course, at the end of the day, you're still compounding 4% a year on average. So because I know I am an impatient person, I know my flaws, and impatience is one of them. So I'm going to give 2019 a try. I'm going to go with writing covered calls for the whole year and see what happens. Even if I have bad months, I'm going to continue for the rest of 2019 by just writing covered calls, nothing else. So basically, I'll be buying stocks that I'm comfortable owning, but I won't necessarily care about the price. So for example, Activision, I bought at 46 and I immediately sold call options against them, expiring, I believe, March 1st. Bought at 46 and I sold the call option at a 46 strike price. I collected whatever I collected. I think it was $1.60 about, and then the stock dropped. But then come expiry date, if the stock is trading below the strike price that I chose, well, I just reduced my cost basis. So I didn't actually pay 46 for Activision. I ended up paying 46 minus the call premium that I collected. So guess what? I could do it again the next month if that's the case. If it's trading above my strike price, then my shares will get sold at 46. But I collected the $1.60. So that'll be my profit for the month, which is about 3 to 4%. So my strategy for the rest of 2019 is to write covered calls, basically to try to make 3% per month on my whole portfolio. That's my goal. That's what I'm going for. Obviously, it's not going to happen. It's not going to be consistent every month. I expect to get burnt a few times, but this is what I'm going for. This is what I'm going to try for the rest of the year to see what it's going to end up providing. And if, of course, at the end of the year, if I made 20% or more, then it's definitely the strategy that I'm going to keep. And obviously, I'm going to compare it with the general market. If the general market also made 20%, then it might not be a good strategy. But by looking at the general market, you can't just look at price at the beginning and the price at the end. You have to look at buying on average every month, because you're not just going to be investing once per year. You're probably going to be investing once per month. So to truly calculate the return compared to the market, you have to assume that you would have bought every month regardless of the price. And that's how you'll compare with the general market. So what I like about covered calls is that you don't have to wait for the stock to go up to make money. So you collect your potential profit upfront. As soon as you buy the stock, you sell a call option, and basically that's the profit that you plan on making. You collect it upfront, and then you wait a month to see what happens with the stock. If it's trading above your strike price, the shares will get sold at that price. If it's trading below your strike price, you get to keep the shares and potentially sell another call option the following month. If it's trading much lower than your strike price, then that's the bad situation. That'll be the annoying situation, because you won't be able to sell a call option at a strike price near your purchase price, because your shares could get called away at that strike price. So the strike price you choose, you have to be comfortable selling the shares at that price. And the further you are from the current market price, the smaller the premium. So in the case where the stock drops considerably compared to your initial strike price or your initial purchase price, one way to mitigate that is probably to buy more shares of that stock, so you can dollar cost average and then sell call option again on a new strike price, which is sort of what I did with Activision. I initially bought it at 46. And then it dropped to 43, I believe. I bought it at 43, but then it even dropped some more to 40, but it came back up now to 44 and even 45. So it was sort of a roller coaster in the past month, probably because of EA Sports, or Electronic Arts, sorry. So yeah, you can see here it dropped all the way to 40. So I bought it initially at 46, and then I bought it again at 43. So my new average price for Activision is 44.7, but the first call premium I sold was at 46, and when I bought it at 43, I could have sold call options at 43, but I sold it at 46 because the premiums were high enough. It allowed me to sell it at 46 as well. So now my new average price is 44.7, but I sold call options for $1.95. So my true cost of Activision is 44.7 minus 1.95. So I'm actually at 42.75. So in reality, I only start losing money if the stock drops below 42.75 and if I can't sell call premiums at 42.75. So the stock really has to be trading at $30 for me to be in a bad, or even $35 for me to be in a bad situation. But as long as the underlying stock that you're buying is a stock that you're comfortable owning, you trust in, you limit the downside or the risk involved with writing covered calls. So that's the strategy I'm going for in 2019. Basically, since November, I've collected about 5,700 Canadian in call premiums. So that's also another reason why I'm pursuing this, because I don't think I would have made that much with dividends or with swing trading. Although swing trading allows me to make better returns per trades, but I have to wait, because I could buy a stock at 50. I don't know when it's going to go back up. I could end up waiting 3 months or 6 months. Actually, a subscriber made this good analogy, and I think for that reason I'm going with the writing covered calls. His comment actually impacted me. Instead of waiting for the home runs, you can go for several singles. So all those singles will generate less points, but they're more guaranteed and they're more consistent. So instead of waiting for a home run, I'd rather generate consistent small gains. And as long as I'm consistent, at the end of the year, I think I will surpass the returns I could have made by swing trading or by dividend investing. I know most of the comments I get are about dividend investing. Most subscribers prefer the buy and hold strategy and dividend investing. But I mean, you have to go with what you're comfortable with. And knowing my personality, of course, I know that I don't have the patience for dividend investing. I mean, really, the only thing I like about dividend investing is the passive aspect of it and not having to worry or follow anything or care. But it takes time. And I also don't believe that every 25-year period is the same. So just because the last 25 years were generated this much of a return, for example, does not mean that the next 25 years will generate the same. You could end up after 25 years only 10% up or 20% up. So that would be very frustrating. I mean, I think I made this example before, but look at Suncor. If you look at the past 5 years, it's trading at 36 and now it's trading at 44. If you go a bit further back, here, let's go here. Let's go to 2008, trading at 70 and now it's trading at 44. So in 11 years, you'd be down with Suncor. Yes, you probably collected some dividends along the way, but your capital lost value. If you go back to 2006, it was trading at 50 and now it's trading at 44. But of course, if you compare from 1996 to 2008, that's a perfect 25-year period. So not every not every 25-year period will be the same, and I don't think we're going to be experiencing the same kind of growth we had in the 1900s. For example, if you bought a house in the 1980s that you bought it for $50,000, right now it's worth, I don't know, $600,000 or $1 million. If you buy a house today for $1 million, it's not going to be worth $15 million in 25 years. It'll increase in value for sure, but that same house that you bought today for $1 million will not be worth $15 million in 25 years. So yeah, I just want to share with you my investment strategy for 2019. I'm open to comments and feedback, of course. Leave them in the comment section below. As always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get between $25 and $250 back, depending on your deposit. And yeah, it's tax season, so if you're looking for an accountant, don't hesitate to message me on my website directly. Link will be provided below. Thanks for watching.